The U.S. economy has achieved its fastest growth rate in nearly 2 years during the second quarter, a development worth discussing as it signals both promise and caution ahead. Summary of key points. The second quarter GDP growth has been revised upwards to a vigorous 3.8%. This upward adjustment is largely driven by robust consumer spending. There has also been a notable decline in weekly unemployment benefit claims, with a decrease of 14,000 to a total of 218,000. In a striking report released on September 25 by the Commerce Department, it's clear that the U.S. economy expanded more than earlier estimates indicated during the second quarter. The growth, fueled by strong consumer spending and considerable business investment, does hint at a slowing momentum as the consequences of tariffs and ongoing policy ambiguity begin to take their toll. What's particularly eye-catching about this strong growth, registered as the fastest since the third quarter of 2023, is a notable contraction in the trade deficit, which was influenced by a significant slowdown in imports. Additionally, companies are showing resilience, as denoted by data indicating that demand for business equipment surged in August, largely thanks to a booming investment in artificial intelligence (AI). Cumulatively, there was a drop in first-time applications for state unemployment benefits last week, suggesting that businesses are keen to retain their workforce, even amidst challenges. This strong economic performance appears to signal that further interest rate cuts from the Federal Reserve may not be necessary at this time. Economists attribute the slow hiring rates to the tariffs imposed by previous administrations and the crackdown on immigration policies, suggesting that if job growth falters, it's less about the economy's health and more about policy decisions. Christopher Rupke, chief economist at FWB Bonds, pointed out that the current level of Fed interest rates is not slowing the economy and is not harming the labor market either. He emphasized that the signs of sluggish job growth stem more from policy than economic issues. The latest GDP figures reveal a significant upward revision, with the economy now registered to have grown at a revised annualized rate of 3.8% last quarter, compared to the earlier recorded 3.3%. Interestingly, economists had anticipated no revisions to GDP growth. The government also updated national account data from the first quarter of 2020 through the first quarter of 2025. The economy initially contracted at a rate of 0.6% in the first quarter, slightly lower than the previously noted decline of 0.5%. Notably, while growth estimates for the first and fourth quarters of 2024 were significantly adjusted downward, this was counterbalanced by upward adjustments to second and third quarter GDP estimates. Overall, the economy grew at a strong 2.8% in 2024, unchanged from earlier evaluations. The sharp reduction in the trade deficit, primarily due to a drop in imports after prior surges, served as a key contributor to last quarter's GDP recovery. The trade deficit positively contributed 4.83 percentage points to GDP growth, after subtracting 4.68 points in the first quarter. In the first part of 2024, businesses rushed to import goods to evade rising duties, which inflated the nation's average tariff rate to unprecedented levels. Trade dynamics may continue to positively influence GDP in the third quarter. A separate report from the Commerce Department indicates that the goods trade deficit significantly contracted by 16.8% to $85.5 billion in August, as imports fell sharply. The upgrade in second quarter GDP figures primarily reflects an upward revision to consumer spending, now estimated to have risen at a pace of 2.5% instead of the earlier reported 1.6%. This includes increased expenditures on essential services such as transportation, finance, and insurance. Consumer spending, often dubbed the backbone of the economy, increased at a rate of 0.6% in the first quarter, marginally revised up from an earlier estimate of 0.5%. Moreover, business investment in intellectual property products has been upgraded to a solid 15.0% growth rate, up from the previously estimated 12.8%. Investment in equipment also grew faster than initially reported, at an 8.5% rate as opposed to 7.4% in earlier assessments. As we move into the third quarter, business expenditure on equipment remains stable, although a slowdown in growth rates is likely. A third report from the Census Bureau noted that orders for non-defense capital goods, which serve as an important indicator for business investment, grew by 0.6% in August, following a 0.8% rise in July. Meanwhile, shipments of these core capital goods dipped by 0.3% after recording a 0.6% increase in July. On Wall Street, the reaction to this set of data was negative, as investors interpreted it as a sign that further rate cuts may not be forthcoming. As a result, the dollar gained strength against a range of currencies, and U.S. Treasury yields increased. Looking ahead, expectations indicate slow growth in the latter half of the year. A recent 25 basis point rate cut brought the Fed's benchmark overnight interest rate down to a range of 4.00% to 4.25%. While inflation revisions have been minimal last quarter, overall inflation has not responded quickly due to businesses offloading inventory that had been accumulated before tariff activation, with some costs absorbed by companies themselves. The accumulation of inventory dropped at a rate of $18.3 billion in the second quarter. Notably, final sales to private domestic purchasers, which exclude trade, inventories, and government spending, and are regarded as a key indicator of economic health, grew at a revised rate of 2.9% in the second quarter, significantly higher than the previous estimate of 1.9%. Economists remain cautious, anticipating a slowdown due to the ongoing uncertainties surrounding trade policies and the mass deportations that could limit job growth due to a reduced labor pool. Lydia Bussour, a senior economist at EY Parthenon, remarked, "Even though moderate GDP growth is projected for the third quarter, driven by resilient consumer spending, AI investments, and fluctuations in international trade, a deceleration in growth is expected in the second half of the year." Current growth estimates for the upcoming third quarter converge around 2.5%. Interestingly, profit forecasts were notably revised downward last quarter, reflecting that businesses may not have passed all tariff impacts onto consumers. Economists caution that a compression in profit margins could exert pressure on the labor market. Furthermore, a fourth report from the Labor Department revealed a decrease in initial claims for unemployment benefits, dropping 14,000 to a seasonally adjusted figure of 218,000 for the week ending September 20th. Ryan Sweet, chief U.S. economist at Oxford Economics, pointed out that the impact on corporate profit margins has been relatively minor, which is a crucial aspect to consider. If profit margins continue to compress, the likelihood of significant layoffs will increase. This complex web of economic indicators and policy implications paints a picture of an economy that may be growing, yet remains fraught with challenges. Given the intricate dynamics of trade, consumer behavior, and fiscal policies, what do you think will be the biggest determining factors for economic growth in the coming months? Will businesses adjust their strategies? Or will the challenges become too significant to navigate? Share your thoughts.